A nation in peril. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, shocking new data shows a major country is facing an imminent collapse. And to make matters worse, the UAW now is threatening to push the U.S. economy into a recession at the time that Congress happens to be doing what they do best, and that could spell bad news again for the U.S. economy. And on top of that, we have a major report out that shows that the global economy is set to slow. We're going to make the continued case why they're wrong, and more likely, we're heading into a global recession, if not outright global financial crisis. And if you're wondering what we're doing in London, England today, well, it just so happens this is the epicenter of our lead story. As the UAW now is set to expand the strike against GM and Stellantis while sparing Ford, as General Motors and Stellantis face walkouts at 38 more facilities as talks with their worker union failed to make headway, even as Ford Motor Company was spared the escalation after making progress in the negotiations. And we're at a point where we see the U.S. economy is at a fragile state. We just heard from Fed Chair Powell suggesting he's concerned about further rate hikes that may be too much for the economy to handle, and now we're seeing a mass walkout of the major manufacturing base of our automotive sector, which is going to have contagion effects to a lot of small and mid-sized manufacturers. They're going to have no choice but to announce temporary layoffs if this continues. That's going to put burden not only on the state unemployment buckets, but also from the standpoint these workers will have less income, and at a time the U.S. economy, we're already seeing trends of it slowing down. What we don't need is a push over the edge, and this might actually do it. And if it doesn't, well, the simultaneous action right now of House Republicans, and again, what we're seeing out of Congress is what they do best, which is really a whole lot of nothing. The problem is when they do that, sometimes it's at the wrong time, this being one of them. As House Republicans are charging toward a government shutdown, and here we can see they're struggling to unite around a plan, and that sends problems again for the economy, as you're about to see. The GOP's bitter divisions have made them unable to even formulate a concrete set of demands. That foreshadows an extended standoff with the White House and Democratic-controlled Senate as the U.S. economy absorbs shocks from the shutdown, auto worker strike, and rising gasoline prices. Of course, you'll notice nowhere in this is the absence of pandemic stimulus or the resumption of student loan payments. None of that is in there, or even the fact that higher credit card minimum payments are going to continue to bite on American consumers because they lag, of course, Fed rate hikes by about 2 months. So we're seeing this kind of confluence of events happening at once. And what we do know about recessions, sometimes it doesn't take a big event. Sometimes it can be just the wrong little event at the wrong time. And we're seeing that start to happen. Unlike the unprecedented U.S. default and potential tumult in global financial markets threatened during Washington's debt limit confrontation earlier this year, the economic consequences of a shutdown largely depend on how long it lasts. And that's really important here because it is the length. If it's just a day or two, it doesn't matter. You start to get into weeks, potentially even a month, and now you can have serious damage to the economy. A lapse in federal funding were cut a whopping to 0.2 percentage points from GDP for the quarter each week at last, according to estimates. Now, already we can say, well, perhaps there's margin in GDP because it's running pretty good. I have a hunch it's going to be revised sharply lower. We made the case in yesterday's show that a decline in imports will lead to a decline in GDP. We're going to make further case here of why 0.2 points is just too many to begin with. With forecasters already anticipating slower growth and extended shutdown risk tipping the U.S. into a recession one, a shorter one obviously, carries less risk. In financial markets, they don't like it either. They're more focused on the outlook for continued elevated Fed interest rate hikes. A shutdown may push up longer-term Treasury yields, a case that we haven't ever seen in the past, further increasing borrowing costs for corporations and government entities because the notion, and this is false, that for some reason shutting down the government causes borrowing costs to go up. Well, that's not how the bond market works. It's based on growth and inflation expectations. So if the shutdown lasts persists long enough, it has a bite effect of we could see on future growth. It eventually leads to lower yields. Now, we don't have a lot of data on this, but we do have a little bit going back to 2018, late 2018, early into 2019. The government shut down for about a month, and lo and behold, what happened? Interest rates went down, not up, as the experts are suggesting they might. But meanwhile, the global economy is poised to slow as rate hikes spike, according to the OECD data. And of course, they're suggesting that central banks must remain restrictive to tame inflation. And that is something that, of course, is only a myth and propagated by central bankers are going to make the case of why not only the global economy is going to slow, but it's going to actually go down a lot faster than most of these experts believe. But one thing that shouldn't be going down at all is your trading account, because if you had CTA-Timer Pro, of course, you'd be able to stay on top of our crude oil trade here as we see the markets reverse. We'll have a full update on Sunday. Trade up now 8.1%. We're seeing a move higher in crude. We saw our pullback. Our machine says, hey, you might want to get out of this, and many of you did. Now we're saying here, this was a buyback in point. It's rallying up, and we're hearing calls for it to go as high as 100 a barrel. That would be a double-digit trade, and all you had to do was just $30 a month. There's a link in the description below. 14-day money-back guarantee. Here you can see August 31st. There it was buying up into that gap up trade, suggesting that was your buy signal. Here you've got on September 4th, where it's been since, maxed out to the long side, and as we made the case, where the machine goes, people follow, and that means the probability that crude goes higher, well, at least in the short term, would add to the fact that that would be a great trade. Meanwhile, growth will ease to 2.7% in 2024 after already subpar expansion of 3% this year, according to the latest OECD forecast. With the exception of 2020, when COVID struck, that would mark the weakest annual expansion since the global financial crisis, which isn't something to really brag about, because we've been hearing about how the global economy is likely to boom, and now we're hearing signs that it's slowing at the fastest pace since. And while high inflation continues to unwind the world economy, remains in a difficult place. We're confronting the double challenges of inflation and low growth. So there you have it. We talk about interest rates, and we're looking at why traders are shorting the bond market, because they believe that long-term rates need to normalize above short-term rates. But here you can see it in the OECD report. They're saying, look, low growth. Remember, bond interest rates are a function of growth and inflation expectations. Where growth goes, demand falls, and eventually growth comes down, and that tells you that inflation is going to follow with it, and all that means is yields likely to go down, not up. A stronger than expected start to 2023, helped by lower energy prices and the reopening of China, global growth is expected to moderate. The impact of tighter monetary policy is becoming increasingly visible as businesses and consumer confidence have turned down, and the rebound in China has faded. And of course, there's always, the effect that it must be monetary policy based, but there's this lack of understanding that there was a lot of stimulus money left over. We know that is likely almost gone, if not entirely gone now. And then on top of that, as we made the case, resumption of student loan payments, higher credit card minimum payments. This is all affecting the consumers at the wrong time. But the real issue here is what monetary policy does to the banking system, and this idea that we're just going to have a period of slow growth is again a fantasy propagated by central bankers. Because here you can see real gross domestic product in blue on a year-on-year rate of change against the net percentage of domestic banks tightening standards for commercial industrial loans for banks of all sizes, or firms of all sizes. And here's what we know. When banks start to constrict credit, what that means is growth heads lower. You can see it, banks tightening lending standards. There goes GDP down. You see it backwards here in the 1990s. You see it during the global financial crisis. You see it during the pandemic. And you're seeing it now. The difference is we're going to see GDP growth roll over and head down here. And the idea that banks are done tightening, well, based on what the Fed has been telling us, how they're going to keep rates not only elevated, but potentially go up a little bit more and hold them there for a long time, says the curve's going to remain inverted for too long. Banks likely here to increase the tightening of lending standards, further constricting credit creation. And next thing you know, we're not in a soft landing. We're trying to get out of a hard crash. The OECD cautioned against easing up, though, because, hey, we haven't done enough because core price gains remain stubborn in many countries. And if we don't keep it up, well, then we'll just send the economy into a complete nosedive, even as headline gauges head lower. There's a limited scope for any rate cuts until well into 2024. Of course, by that time, we're likely to be in a depression at the rate things are going, with how much credit is being restrained, how much new money is being created at a time when we have record amounts of debt. You look around historically, throughout time, we see these big giant bubbles form, and as soon as you restrain credit, eventually they start to pop, and when they burst, there's just nothing the central bankers or money printers or whoever they were throughout history can do to stop it. And yet all the experts still believe soft landing, just a slowdown next year. I think this time next year, we won't be talking about a soft landing at all. Monetary policy needs to remain restrictive until there are clear signs that underlying inflation pressures have durably abated. Meanwhile, we could just look at the banking data and say, well, it's bound to happen, because here we see the consumer price index now overlaid against the net percentage of banks tightening lending standards for commercial industrial loans to firms of all sizes. And what do we know? With a lag effect, because it makes sense as you restrict the credit creation mechanism, eventually demand goes down, and the consumer price index, being one of the most lagged indicators out there to begin with, it eventually follows suit. Here you can see in the early 90s. Here you can see in the dot-com bubble, banks have been tightening standards, and finally demand comes crashing down. Same thing into the global financial crisis. Consumer prices were rising, so banks were tightening lending standards, and eventually both came crashing down. We see it briefly here following the 2015-2016 tightening, and now we're seeing it again, except the belief here is inflation is going to go higher, but at some point, as you continue to reduce the amount of money created in a debt-based economy, the only path for inflation, my friends, is lower, not higher. And I know that's controversial. I know a lot of people don't believe it, but nevertheless, that is what we know about how our system actually works. A 25% rise in oil prices since May has also led to inflation ticking up in some countries. Of course, our CTA-Timer Pro on top of that trade, depending on their exposure and whether they are importers or exporters of fossil fuel. That is obviously unwelcome. Oil prices will continue to be potentially volatile through the period, and that's why we've highlighted as one of the risks. The impact obviously will be, as we've learned, a squeezing on household budgets and on demand, something I've been making the case. You see it here. They're finally agreeing with something and says, wait a minute, higher energy costs means less on the discretionary spending side, absolutely. And then you start to look at the fact that we're further constricting credit. People's credit cards are maxed out. They don't have the money to spend. And so that means a further pullback on discretionary spending at a time when people have a lot of bills to pay. Inflation's still a problem. And then at some point, everything snaps and it all changes. But for crude oil, can it go higher in the short term? You can. But I also want you to caution you, our machine positioning will catch the reverse when it comes. And sure enough, it will eventually be here as we look at crude oil prices in blue, now against the net percentage of domestic banks tightening lending standards for firms of all sizes. Here again, you see as banks were tightening back in the 90s, oil came down. You can see here going into the dot-com bubble, banks had been tightening standards. Oil prices rallied till they came down. Again, during the global financial crisis, it eventually bites, and you're seeing it now, this kind of rebound suggesting that, hey, maybe we're past this. Even though back in 2015, 2016, we saw it during the pandemic. This time, no, it's different because we're seeing a rebound. No, eventually, the constriction of credit will hit the oil prices. You watch, our report will nail the reverse, and you can have that as yours as well. Again, link in the description below. But now let's get into our headline story, because UK job recruiters are saying demand for staff drops to 3-year low. So we're going back here a few weeks ago to an article that kind of suggested things in the UK were going wrong, and now wait till you see just how bad it gets, because this is where it begins. You know, remember, I've said eventually there's a slowdown, and then what happens in the factory sector? They work back through those new orders. Then when the new orders they get caught up on, they go to the backlogs, and as they flow through the backlogs, eventually you have no work and too many workers, and so what happens next? You got it. The Recruitment and Employment Confederation measure of permanent staff placements dropped to 38.9. This reading behold the threshold of 50. This is much like those PMI reports suggesting a contraction in permanent staff placements. It was the 11th consecutive drop and the steepest since June of 2020 during the pandemic. So we're seeing, understand this, from the labor side, which everybody said is not going to change, a big decline. Demand for temporary staff also shrank for the first time since COVID. Together, the figures point to lower inflationary pressure coming from the jobs market, which is a key focus of the Bank of England as policymakers gauge how long to keep raising interest rates. And this is exactly what we said should happen. And those temporary jobs are a leading indicator. Then eventually you see the part-time, full-time jobs follow suit. But now look at this latest report. We just got some new data coming out of the United Kingdom, and it is outright ugly. Weak Euro area PMI data suggests economy is facing a contraction as a composite PMI at 47.1 in September. Let's dig deeper here. The index, based on surveys of purchasing managers by S&P Global, showed a fourth consecutive month of falling output. Remember, it wasn't just last month. Everyone thought the bottom was in. We said not a chance, hitting 47.1. While that's a slight improvement on August, the reading is clearly below the 50 level that indicates a contraction. We expect the Eurozone to enter a contraction in the third quarter. Our nowcast, which incorporates the PMI indices, points to a drop of 0.4% compared to the second quarter. The PMI numbers for September showed negative readings for both manufacturing, which has been below 50 for 15 months, and services that everyone said was going to pull manufacturing higher. We said no way, which in the first half of the year compensated for the weakness in factories. The region's two biggest economies were the key drivers of a downturn in activity. While the slump eased in Germany, it deepened in France. Economists have expected momentum in both countries to remain broadly stable. And we kind of said this would happen. As Germany plunged down, we watched the manufacturing sector now get into depression level readings. And we said there was it would flow out to the peripheral countries. Now we're seeing it hit France. It's starting to happen. Now maybe the slowdown in Germany has abated a little bit, but hang tight. We're not done yet. Separate S&P Global data for the UK showed private sector companies, this is what we've been saying is going to happen, and it hasn't happened in Europe yet, or in Germany or France, but it's coming, shed workers at the fastest pace since the pandemic and the depths of the financial crisis more than a decade ago, suggesting the UK is now a nation in peril, running the risk of a recession. The gauge slipped to 46.8 in September from 48.6 the month before. Again, the sharpest decline in output since January of 2021, worse than the economists expected. And as more people hit the unemployment line, well, that means less money not only flowing to the stock market, but less money for discretionary spending because their incomes are going to go way down. And that what money they do have is going to be eaten up in food, energy, and debt and housing, leaving little, if any, money out for the rest of the economy, setting off what we know is a spiraling effect that will pull the global economy down. We didn't see it starting in the UK, but maybe this is it. In Germany, the performance of the services sector was a pleasant surprise as it only contracted marginally this month. Meanwhile, the manufacturing sector has been suffering from a slowdown in the global economy, and higher rates led the decline in overall activity. As we've said, things in Germany, not good. In France, both services and manufacturing worsened, setting private sector activity down by the most since November of 2020. There were widespread reports of weak demand in both sectors, and confidence regarding the next 12 months weakened noticeably. Again, a sign that all this pandemic stimulus is long gone. The French economy is steering towards some choppy waters. We think economic growth will be lower in 2024 than previously expected. That might be the understatement of the show today. There's no doubt economic growth is going to be far lower in 2024 than it is today when you start to see these reports of further contractions in manufacturing and services sector throughout the world, and we know eventually layoffs would start. I imagine in the next couple of months we're going to see acceleration of those layoffs, and wait, at some point they're coming to America, and when it gets here, it's game over, and the next, will be the nation in peril. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.